We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Kao, former hedge fund manager and commodities trader, private family office investor, and also the author of Cowboy Musings on Substack. Thanks for joining me today, Michael.
Oh, thank you for having me. I've been a fan of your podcast for a while, so
thank you very much.
Honored to be on.
It's an honor to have you as well, and I'm really looking forward to this conversation because, you know, we're going to touch on a lot of different topics and different ideas that aren't necessarily within the gold space, but I think it all really is interconnected. You know, the way that you look at inflation, the way that you look at energy prices, how that affects the world, and let's say the cycles that are in some ways a butterfly effect from those very important forces in the world. I really appreciate, you know, getting to dig into your how you look at the world and you know, seeing how you put all these pieces together.
I love that you used butterfly effect, because that actually, I think back in 2021, one of my that 2020 beginning of 2021 was really when I kind of discovered Twitter and started tweeting stuff, and I wrote a thread some that was called, I think, the commodity inflation butterfly or something like that. And my thesis back then was that oil, being the most important commodity in the world, had a number of things going for it that would spell like a big bull market. Mm-hmm. At the time, I thought it was going to be a pretty long structural bull market, and we can talk a little bit about how my views have evolved since then. But what then happened, what I said, the butterfly effect that I was referring to, is that this bull market in oil would effectively light this inflation conflagration, as I call it, and essentially leap into other areas. And you know, by the sort of end of 21, it was very evident that it had, right, and it started leaping into, you know, shelter, much stickier components. And the butterfly effect would be that, and this was, you remember, this was a pretty out of consensus view at the time, but in 2021, I said, you know, I basically said, this is going to cause the Fed to get very hawkish and go on an aggressive rate hiking cycle. And if you remember the zeitgeist at the time, there were a lot of people that said, oh my gosh, you know, given the debt levels, given you know, blah, you name whatever reason, there were a lot of people pushing back on the idea that the Fed could raise Fed funds by higher than, say, 2.5% to 3%. I remember I was diligencing a private real estate fund at the time. And I remember having this exact conversation with them because, you know, the concept was very interesting. It was a niche industrial play, and everything was fine until they were telling me about their warehouse line that was all, you know, floating rate. And I said, okay, so, you know, we're sitting here at essentially the zero bound here. Are you guys planning on terming that out? And the finance director of the fund said, oh, we just can't see a scenario where the Fed will raise Fed funds higher than 2.5%. And I basically ended the conversation. I said, I'm out. So at any rate, you know, so I predicted that would happen, and it would cause that's when I started using that phrase, the US dollar wrecking ball, because a strong dollar is a huge headwind on all sorts of risk assets. And I said that it would create a big problem with especially high duration assets in 2002. And that's when you saw like the tech crash, the crypto crash and all that. But yeah, so that's been a hell of a butterfly effect. But I think that butterfly effect isn't over, because in the summer of 2022, I wrote another long thread about warning about the whether we're on the precipice of an Asian contagion 2.0, and I note the thing that really worries me, and the thing that makes me think that that is still a possibility, is that when a similar episode where a strong dollar created a number of devaluations in emerging market currencies in the summer of 1997, people thought that, oh, okay, well, it's just kind of in that little sector, and then it kind of ended. But you remember, it took 18 months between that initial wave of devaluations of like the Thai baht and the Malaysian ringgit in July, I believe, of 1997. Took 18 months before it cascaded into this massive crescendo of panic, which ultimately took LTCM down. It caused Russia to default. And so when I think about when the dollar wrecking ball really started waking up in 2022, right? We're kind of on target for something bad if the U.S. dollar wrecking ball continues to strengthen. So it's something I'm watching very, very closely.
Well, Michael, there's so much to dig into in there, and of course, you're fairly focused on oil. You've said that energy is the linchpin of inflation, and that's what I want to discuss with you today is seeing this tug of war between all of these different forces in the world. I think it's really important for people to understand what these forces are and how they can affect the price of this most basic and most important underlying commodity, which has a direct consequence on every other price within the market. So, as we're discussing the fastest and biggest rate hiking cycle in history, do you think that there are more of these butterfly effects or lagging effects within the economy that we have yet to see just from the 10 hikes that we've seen so far?
Oh, for sure. The first one being the U.S. dollar wrecking ball, because I think when it peaked out last year at DXY, I'm talking right under 115, right? And so obviously it traded down to close to 100, and now it stands at 104. But a lot of people were very, very quick to call the cyclical peak in the dollar. And I said very early on, and we'll see if I'm right, the jury's still out, but I said not so fast, because the Fed at this point doesn't have to keep hiking for that dollar wrecking ball to continue going. Mm-hmm. All it has to do is pause and wait for other central banks to outdove it. And the reason why I think that's a likely possibility is that I don't think the other main economic zones, namely the Eurozone, Japan, UK, and of course China, I don't think any of those four central banks can really out-hawk the Fed. China, as we all know, is undergoing a serious hangover from its zero COVID policy and its real estate debacle of the last several years. And so they've been pumping liquidity into their system, and they're not done. I think they're part of the reason why commodity prices have struggled despite 3 OPEC cuts now is that this great China reopening has completely been a dud, right? Despite flogging the dead horse, as I call it, right? They keep printing yuan, and they're going to have to continue. Japan is kind of in a similar situation, right? They've basically had yield curve control for a long, long time. It's not clear to me how they can even get out of that, which basically leaves the Eurozone and the UK, the Eurozone being the main one. And I think that there are some structural issues, even though their inflation readings are still quite a bit hotter than ours at this point in the cycle, and their equivalent rates are lower than ours. I think that the essentially the transmission mechanism for monetary tightening is much more efficient in those areas because they have structural impediments. We had hints of it, right? We saw the gilt crisis last fall in the UK, and I note, by the way, right now I'm watching very closely that gilt yields are approaching the past highs when they had to come in and intervene and do a QE, essentially, right? And the eurozone, I think the Italian and German economies, in particular, are weak, showing signs of very quick weakening. And by the way, that's before we get into an unknown winter. Last year, I keep saying the only reason why Lagarde has been able to talk as tough as she has and talk as hawkishly as she has is because Mother Nature gave the Eurozone a complete pass last year, right? With all of their green energy policies, you would have thought that a Russia invasion of Ukraine could have really put the hurt on Europe. And you saw the initial fear in TTF gas prices, but it obviously collapsed when Mother Nature delivered like the warmest winter in 40 years. But the problem is that I think Germany has learned a bad lesson from that. You see it in their sort of efforts to double down on what I call the Gretaverse bets, right?
I like that term, the Gretaverse.
Right, decommissioning the nukes and continuing. I mean, it's kind of ironic. I mean, usually when people add where folks add a ton of wind and solar at scale, it's in places where the sun shines consistently and the wind blows consistently. You get neither of those in Germany. So right, but Mother Nature has given them a pass, and I fear for Europe that they've learned a bad lesson from that. And all it takes is one nasty winter and for them to like blow through their gas supplies, and then you will see very quickly how quickly the ECB will fold in its inflation fight. Mm-hmm. That's what I think.
Yeah, and it's crazy. I mean, just lingering on that point for a second, it's crazy to think about, when they institute these policies of, as you say, the Gretaverse, which is, I'm going to have to use that more often now, and yet they've only increased their coal production more than anything else, or their coal consumption more than anything else. How do people hold those two ideas in their head at the same time, thinking that they're, depending on green energy, shutting down their nuclear reactors at the same time, yet objectively using more coal than ever?
100%. I think the kind way of putting it would be that's cognitive dissonance. The not so kind way is, I'd say, it's total hypocrisy, right? Mm-hmm. Because I mean, look at China. China will basically say all the right things at all the climate accords, but they are by far the world's biggest pollutant. They don't care. I've been watching oil, in a way, all my career, but more intensely over the last decade. Because in the 2015 to 2020 period, when I was still running my fund, I stopped actively running my fund in 2019. But in that period of time, I'll call that period the shale, undisciplined shale period in oil, right? I was basically trading a lot of distressed debt in energy, and so one of the big restructurings that I participated in was the bankruptcy of an upstream MLP, and basically we, along with 10 other hedge funds, put in a bunch of capital and bought out the Permian assets of this carcass and recapitalized it. So my stake in my economic interest in oil is a very long-term bet in a post-reorg private equity that arose out of the ashes of this restructuring. So But I've had this long-term structural vision for oil for a long time, because when that commodity price crashed so hard and stayed down for so long during that period, there was essentially you had the confluence of long-term capex projects. I'm not talking shale now. I'm talking about like deep sea, the big projects around the world essentially get shelved. And these big projects typically have, anywhere from, 5 to 8 year gestation cycles, right? So that capex completely got shut off. And you also had this period of intense, I guess, capital, capital channeled into green energy and energy ESG initiatives and transition, energy transition. And then you also had, in the period of after COVID, of course, COVID was like a total singularity, but after COVID, we had the election of President Biden. And I think one of my very first posts on Twitter, I think this is February of 2021, it was very clear to me that the Biden administration was going to be very hostile to the industry. He did a number of different things. I wrote a thread about it saying, things are going to be very different in these next 4 years, because, he's basically canceling Keystone. He's essentially talking very tough against all energy companies, right? He had banned drilling on federal lands, and then also, like, during the year, if you remember, this would have been in later on during the year when energy prices had gone through the roof. Some of the things that really bothered me about this particular Department of Energy, it seemed like it was a complete lack of understanding of this notion of energy self-sufficiency. Because yes, pre-COVID, we hit 13 million barrels per day of total production. And people just say, oh, we're net exporting, I can't remember the exact number. What is it? 6 million barrels per day or whatever it is. And we're energy independent. But it completely misses the point that most of what we're exporting is light sweet. We need to import heavy grades to blend with our light sweet in order to refine it, because our refineries haven't been retooled since the 70s, essentially, right? Mm-hmm. And so when Energy Secretary Granholm talked about, all what we'll do is we'll just ban exports. Well, I wrote a whole thread about how that would actually backfire on the consumer. It would crash WTI, but it would spike Brent and gasoline, because we would have to wind up importing all that, right? Mm-hmm. So my point is that this confluence of all of these factors made me very, very bullish at the very beginning of 2021. And I think, I can't remember when the crossover point was, but a very, very significant signal to me was when the forward curve crossed from contango into backwardation, right? And I looked at a study along with the management team of my private equity, which basically studied the last 11 backwardation to contango flips over the last, call it 25 years. And in 7 out of the 11 cases, it was a very reliable leading indicator on forward spot prices. Now, 7 out of 11 doesn't sound great, but when I tell you, like, the other 4, I can't remember all 4 off the top of my head, but I know that, like, for instance, one of them was the end of the Iraq War. Another one was the most recent one that everybody probably remembers is what I call the Trump rug pull of 2018, where he had taken us out of JCPOA, right, and then basically promised no waivers, and then had the Saudis flood the market, and then he granted 11 waivers. So those are the counter examples to why that signal didn't work. but they were very one-off, kind of sort of unexpected geopolitical events, I would call them. So if you look at the track record of the other flips, it was a very, very good leading indicator, right? So that turned out to be the right call. But last year, in 2022, I basically wrote around April. By the way, around April of 2022, I started getting somewhat cautious on oil because there's a having been in. I started my career trading commodities in the early 90s at Goldman. And, I'm sure we've all heard the phrase, the cure for high prices is high prices, right? And so when you have a tightening cycle along with the dollar wrecking ball that it creates, along with rising commodity prices, there's got to be a negative feedback loop, right, on demand. Mm-hmm. And so that's when I started getting cautious about it around April. I think oil prices peaked around, was it June? Contango to backwardation flips are very significant leading indicators. Late last year, I think around October, I wrote a thread saying, the problem is that now that you've got a very steeply backwardated curve, you don't really have a signal going the other way. Because usually what happens is when you've got a backwardated curve, it usually tells you that the supply curve is inelastic, right? Mm-hmm. And one of my favorite sayings that I use all the time is that the sword of inelastic supply can cut both ways, because when you've got an inelastic supply curve meeting a sudden downward demand shock, say from a credit crisis or from the Fed hiking from a strong dollar, all of these negative feedback loop effects can constitute a negative demand shock. You can have a very, very sharp drawdown in prices, despite all the barrel counters saying, "Oh, look, the physical supply is so tight, that the curve is so backwardated, et cetera." Right? But the question I always ask is, if you have a backwardated tape, how do you end up in contango? By the time you actually end up in contango, you've already gotten killed. You've already gotten annihilated. So, I mean, if you just if you look at what's happened to oil, right? Oil is off. Oil is down to like the 70s from a high of 140. The curve has stayed backwardated the whole time. It's lessened, but if you had basically looked for the backwardation to contango flip, by the time that happens, you've already gotten completely annihilated. So you have to look at other macro factors and not just be a oil barrel counter. And that's what makes oil so tricky in the near term.
Mm-hmm. Michael, as you were saying, supply is much easier to analyze than demand, right? And 100%. I think this goes to your point about that I want to get to about the singularity that you're going to, or that we're very likely going to experience here within the next 2 years. But why don't we, get back to the idea that you were talking about OPEC's cuts and how they might be premature at this point. There's obviously lots of factors that go into their decisions, but let's split those apart. Maybe to begin with, how does the Fed's actions affect their guidance and forecasting for production at this point?
Well, so when I say that the cuts are premature, I'm primarily referring to the fact that, look, when they cut supply, all things being equal, they are keeping the price of oil higher than it would be normally without those cuts, right? We agree on that, right? And so therefore, all things being equal, incrementally, that's deleterious for demand. It has to be, right? Especially, and the thing is, when it really bothers me when people say, "Oh, there's no hint of demand destruction on oil," blah blah blah. It's so, by the time you see the demand destruction again, it's too late, mm-hmm. And you can't just look at oil metrics for that, because the consumer is now getting remember we talked about how oil inflation leapt into the stickier components. And in my latest thread, it's my pinned tweet. I actually included a graphic of the components of CPI. So what's very interesting is that in the early part of the inflation, it was all energy inflation, right? But as that energy wedge or that energy inflation kind of came back down, you see that basically services and shelter components have picked up, and that's stayed sticky. And I think the issue that I have with OPEC's decision from a long-term thesis perspective, long-term bullish thesis perspective for oil, is that yes, while it seeks to avert short-term pain, it makes the forward supply picture. Yes, exactly. It makes the forward supply picture look much more elastic in my mind, right? Because there's just a lot more slack in the system. So I would actually say, so my supply demand singularity idea is something that I feel like I've been chasing this dragon for a long time. And the frustrating thing, I'll be honest with you, is that every single time it looks like we get close, something bad happens in the world that seems to push it off, right? And so this time around, right, prior to all of these cuts, and I would say that in 2021, 2022 period, I said, you know what? I think there is a potential that that you could have a scenario by 2024 where spare capacity is low enough in the world, and as long as demand doesn't completely fall apart, you could have demand growing to the point where it exceeds all global spare capacity, right? And so if you think about supply curves, right, that's where you have a very, very inelastic supply curve. And so if demand continues to grow, you could potentially have a parabolic price spike in the commodity, right? Parabolic. I don't think of 140 as parabolic. I think 300 is parabolic, right? You could have a situation, a runaway situation where OPEC loses control. But I will say that my views on that have completely changed. And I think that by cutting so early, and remember that I think of OPEC as the central bank for oil. I think of the Fed as the central bank for dollars, right? They each have one tool in their tool chest. The Fed's tool right now to combat inflation is to hike interest rates. OPEC's tool to keep oil prices high is to cut supply of oil. But both of them are restrictive from an economic growth standpoint. So what's unfortunate for OPEC is that they, in trying to pursue their economic objectives, in a way, they have to shoot themselves in the foot, because they're also slowing down the economy when the Fed, which is frankly the stronger entity in my mind, much stronger, hasn't even finished its inflation fight yet. But with these premature cuts, I think OPEC is just helping the Fed along, right? Or well, in a way, right? Because let me rephrase that. They are keeping the Fed more vigilant, all things being equal, right? Because
at this time,
yes, because going back to that chart that you flipped onto the screen, right? The energy component is very, very small. But if I'm the Fed and I'm thinking, wow, OPEC looks like they're going to stop at nothing to continue, keeping the price high, then, even if I posited in my pinned thread that even when you see the shelter components and labor components start to turn soft a little bit, maybe OPEC is going to, come back and do yet another supply cut. That's what I think is in the mind of the Fed. Now I'll tell you what I think. I actually think, reading through the tea leaves of this last OPEC cut, I actually think they might be done for a while, because I think that Saudi Arabia cannot continue subsidizing Russia. Russia has not lived up to its promises, and there are obviously, geopolitical reasons for why they can't really cut. They need oil to fund their war machine, especially with their gas revenues eviscerated. So I detect some lack of solidarity within OPEC Plus, and my biggest concern of a OPEC fracture would be a replay of what happened during COVID. You saw that, that was before there was a plus in OPEC Plus, right? And you remember that, the event that took WTI to negative 38 was a pissing match between Saudi Arabia and Russia. Russia basically, flooded the market, and Saudi Arabia said, well, oh yeah, two can play at that game. And so they literally just tore each other apart and tore the shale industry up in that. But then they made nice and became friends again. But now I see rifts appearing in that alliance.
So, Michael, if we get to a point where, supply and demand are very unbalanced, if demand gets higher than supply, this supply becomes, very inelastic. The idea of the spare capacity comes into play. So how, what is that spare capacity, whether it comes from the SPR or OPEC's spare capacity? Is there enough capacity there to really temper a dramatic upward price shock?
I would argue that there's a lot of spare capacity in the system now. So one of my favorite macro analysts, Lakshmi Srikumar at Capital One, she thinks that OPEC core spare capacity is around, call it 4.5 million barrels per day. If you include I think some of the exempt countries, it goes up to about 6 million per day. And then if you include Russia and I believe Kazakhstan, then it goes up to potentially 7 million barrels per day. Now, I recognize that her estimate is higher than almost everybody's consensus numbers. But even if you haircut her number down to 5 million barrels per day, that's a lot of slack in the system. And this latest Substack piece that I wrote kind of breaks it down, and so breaks down what that forward slack looks like. So long story short, this supply demand singularity scenario, I think the corridor of viability for that supply demand singularity to happen has both been pushed out to maybe 2026, and that window of opportunity may have also shortened. Where I was going earlier about China's coal use has to do with that, because the reason why the corridor may be shortening is that the longer, and so this is the reason why what I'm talking about is OPEC's decision to cut prematurely has created a lot of forward slack in the system. That pushes this singularity scenario further out, right? But it also gives time for countries like China and India to fuel switch. So when you think about what China understands, there's so much to talk about here, because China geopolitically is very, very exposed to oil, right? 80 to 90%, about 80% of their oil comes through the Strait of Malacca, right? Which is this little choke point near Singapore. And so they understand that their One Belt, One Road initiatives have not helped at all. Most of them have flamed out, what I call their Malacca hedges. And so you see this massive EV push within China, and also this massive coal and nuclear push, right? So that tells me that is ultimately their Strait of Malacca hedge, right? They literally want to substitute coal and nuclear for oil. And I'm not that concerned about a similar fuel substitution here in the US because our grid has so many legacy problems with it, and from a transmission perspective as well as from a again, I think our embracing of the Gretaverse here is going to limit the ability for true EV penetration. But just like the emerging economies were able to leapfrog, 2 generations of wireless, right? And to go from, they basically skipped all the first couple generations of wireless and went straight to the most advanced networks. I see the potential for something like that happening in China and India, right? Where and so to the extent that this supply demand singularity gets pushed out, it may never even happen if China completely is able to get away from its oil dependency. So that's my longer term concern, and that's why I continue to think that even though without OPEC support, prices could wind up going into the 40s. But in a way, pulling the Band-Aid off, ripping the Band-Aid off now sets you up for a better longer term bull market that's more sustainable versus a middling type of market that basically where you never experience that singularity event. So yeah, complicated. Complicated.
It is. That's the thing, is trying to put all these pieces together is a really difficult puzzle. But you mentioned Russia's involvement within OPEC Plus. How have the tariffs and what are the the effects that the tariffs have had on Russian oil within the market? How has that situation developed? Have they been effective?
Well, yes and no. It has dented Russia's revenue because a lot of their oil is heavily discounted, right? And I don't think Russia, as an aside, this is one of the reasons why BRICS will never happen, because I don't think Russia is particularly happy that India and China and everybody else have essentially benefited at their expense from these price caps and sanctions, right? But at the end of the day, though, it hasn't necessarily helped global crude balances, because their barrels have kept flowing. It's just that other countries have benefited from the discounts, and less so for Russia. This goes back to why I think there might be some rifts within OPEC Plus now, because I'm not sure that Russia will ever step up to the plate, because they're somewhat hamstrung economically. They need to fund their war machine, and so far Saudi Arabia is really the only one that's subsidizing, right? And they're losing a lot of market share as a result. I opined back in I think 2021 or 2022 when the war first started, and there were all of these hyperbolic claims that we could lose as much as 4 million barrels per day of Russian production, blah 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 blah. And I said, look, to me, the only way that you're going to stop Russian oil flows is blockade the seaborne routes, because there were all of these very, very uninformed takes that, oh well, all this Russian oil is just going to move east directly into China and India. I'm like, via what? Trucks? Crossing the Himalayas? I mean, What are you talking about? There's no infrastructure. There is one pipeline in the very northeast called the East Siberian Pipeline. It's called ESPO. I think the max capacity of that is something like 1.4 million barrels per day, and I think it's already close to capacity. So the bulk of Russia's oil exports are seaborne, which have to essentially run the gamut across all of the NATO allies. So the fact that we haven't, obviously a blockade is casus belli, right? So that is likely not going to happen. But it also tells you that these sanctions and price caps and whatnot, yes, it's hurt Russia economically, but it hasn't stopped oil flows. The oil is out there.
Obviously, another big piece of that picture is China and how what their demand looks like. We talked about the reopening, how you thought it was going to be a bit of a nothing burger, and it really has kind of ended up being that for a lot of commodities. Do you see China as being actually a bigger ticking time bomb for the global financial system because of their debt load and how it's actually structured?
Yeah, in March, at the height of the regional banking crisis, I wrote a piece called "Ball in a China Shop," and by ball, I'm referring to the U.S. dollar wrecking ball. Mm-hmm. And I basically said, look, I ultimately think that the biggest macro elephant in the room is not this regional banking crisis. It's actually China, because in that post, I basically talked about how there's China's, like, the PBOC balance sheet looks pristine compared to many countries, but it's a complete facade. Because if you think about how Enron financed itself with all of these off-balance sheet vehicles that made it a fraud, the PBOC is Enron writ very large, because all of their funding vehicles have been through, like, the state-owned enterprises, the LGFVs, the One Belt One Road projects. China, if you consider all of the debt and try to compare all the countries in totality, Peter Zeihan actually has this unbelievable chart of, like, total private debt, where you basically see, here's the U.S., here's most countries are kind of like within, like Turkey's like, quite a bit higher, blah, blah, blah. And then China's literally goes like vertical, like off the chart, massively off the chart. So when you consider that they really have no internal consumption to fuel their economic growth, and all of it is investment driven. And at this point, right, how many bridges to nowhere can you keep building, right? It's they've done incredible things with their infrastructure by all measures, but there are hard limits to how much you can continue to fuel GDP growth through pure investment-led growth. I think I wrote about in that thread that, look, their economy then is completely dependent on export-driven growth, and it's coming at a time when the Western consumer, which is the primary consumptive engine for driving China's growth, the Western consumer is getting strapped, right? Given inflation of all things. So I basically laid out my reasoning for why China needs to devalue the yuan for a number of different reasons. And I've been saying that there's a bit of a yuan / oil doom loop dynamic going on, because if you think about the PBOC's quandary, I love using the Greek myth of Odysseus sailing through the straits of Scylla and Charybdis, right? You're familiar with that myth. There's no good outcome on either side, right? The Scylla monster, and then there's the Charybdis monster. So from the PBOC standpoint, if PBOC is the ship sailing through the strait, the Scylla monster is a weak yuan, because it could import commodity-based inflation, right? Because because oil is dollar denominated, but it could also, if the devaluation were uncontrolled, it could also set off their debt bomb. Yes, exactly. That's the meme that I created. But then on the other side, the Charybdis monster, the strong CNY, basically erodes their trade surplus, and it creates a headwind to a very export dependent economy. So the reason why oil not holding as a result of this lack of Chinese reopening is bad for the yuan is that it tells you that the fear of importing commodity-based inflation is no longer there anymore. And that, plus the fact that China has been stockpiling its SPR even as we've gutted ours, which really incenses me because I think at some point we're going to need it. But right, so now if the Scylla monster is not that scary anymore, then I think the PBOC is going to steer towards it, which is a devaluation. And a devaluation of the yuan, how that translates into a deflationary effect for the world is obviously that it just means that it just makes Chinese goods relatively more affordable, right, relative to everybody else's. But it puts pressure on all the other countries, Japan, right, Vietnam, all of Southeast Asia and the world. So this is why, going back to that thread earlier that we were talking about Asia Contagion 2.0, I could see that happening. I could totally see something like that happening where, call it, maybe it could happen end of this year. It could happen sometime in 2024. But going back to Asian Contagion 1, remember I said there was like an 18-month window between the first butterfly flapping its wings to the eventual tsunami that it caused. So that's on my radar. And what I worry about with respect to oil is that if we have a situation now where OPEC Plus has effectively shot its wad too early, now 3 times, I call it premature emasculation. They've prematurely emasculated themselves. That's the way I look at it. Mm-hmm. Then what happens if this cut, I mean, in real time, we are seeing, right, that this cut has basically done nothing. WTI, last night, it opened at $75 a barrel. Right now, as we speak, it's at $72.43. It's up only 69 cents when a lot of people were crowing about how, this is going to be like $3 or $4 or $5 of upside. Mm-hmm. This is really bad price action in my view. And what would happen if oil prices wound up going down and it doesn't hold? Well, this time around, as a result of a potential Asia Contagion 2.0, what happens if that happens and now OPEC Plus is out of bullets because it can't anymore without fracturing its alliance with Russia, right? So it's kind of frustrating for me to watch. But look, with the July cut, even though Saudi Arabia is saying that their 1 million barrels per day cut is just for July only, and he's trying to hint that, I'm going to keep the speculators on their toes by saying that it could extend. That takes Saudi Arabia's production down to 9 million barrels per day. It hasn't been that low in years. And you think about it from a cost benefit standpoint, right? What they are losing in volumes is dwarfing even the potential gain in price, if assuming price can even hold up, right? If price doesn't hold up, then they've totally fucked themselves, and they're going to have no choice but to increase production at a time when oil is not even able to find its footing. Now, my view is that I don't know where oil would be today if they hadn't done any of the cuts. But if oil had gotten slammed to like 40, and maybe that makes the Fed more likely to pivot for real sooner, and then at some point, OPEC, if oil really, puked, OPEC has the potential to actually come in with like a real cut with real meat, like 3 million barrels per day, shock and awe. But they're out of bullets now. Mm-hmm. That's my biggest concern.
Especially if they're coming to the market with a cut, and then the market saw that it didn't have the desired effect. They're losing credibility along with the Fed, right?
Well, today's price action should not give any oil bull comfort, I will say, because this is not what any of us would have liked to see. But I've been saying since the very, very beginning. I thought that the April cut in particular was premature. They did a cut kind of in name back in October. Mm-hmm. They said 2 million barrels per day, but I realistically that was more like, call it 800 to 900,000 barrels per day. But between the first two cuts, we're talking about essentially 2 million barrels per day of additional sort of slack in terms of future spare capacity that's been increased, right? So, and that factors into that 7 million barrels per day spare capacity I was talking about. But, after July, who knows if they're going to kind of, whether they're going to be willing to sustain 1 million barrels per day of cut beyond July. But, then you're talking about a spare capacity number that's potentially 8 million barrels per day. That's a lot of freaking slack in the system. Mm-hmm. You see why I'm concerned that this pushes that singularity corridor way out.
So, Michael, looking forward, I want to get your take on these ESG policies and how they affect the industry going forward. You compare it to boiling the proverbial frog in a pot. So, can you explain a little bit more about how you see these policies on this commodity that is so vital for people's lives?
Well, so that was a big driver for why I thought we were heading towards a supply demand singularity, because it definitely has diverted investment, right? And the main thing is that I'm talking about like the big capex projects. Shale, I think, I think shale has potentially seen its best days. I think one of the mistakes that lay people to the oil and gas industry make is that I was at this West Point conference back in February where I presented a paper on the dollar, and I remember having this discussion with somebody who was saying that, if it weren't for COVID, we would be producing 15 million barrels per now. No, we won't. That's not happening. I don't know where that comes from. Mm-hmm. Because we're struggling to exit this year with like maybe 12.8 million barrels per day. And that's with the Permian Basin being the only remaining basin that hasn't peaked yet. Every other major basin in U.S. shale has peaked. And so when you think about what shale has brought for the world, it's essentially created this gigantic wedge of production that a lot of people, a lot of people that don't understand the industry are just kind of extrapolating off of and thinking that pace can continue. It will not. So then where does that leave us? Well, the long-lived, you've got OPEC, obviously, but then the other non-OPEC, non-shale sources, those are the projects that, or the lack thereof, are the ones that worry me, right? From an energy security standpoint, right? But again, so that argues in favor of the supply-demand singularity. What argues against, though, is that you have countries like China and India that also recognize that threat, especially China, where they're so dependent on oil, and so they're moving as fast as they can to get off of their dependency. Whether they can do it or not remains to be seen. See, the thing about oil is that it obviously everybody thinks of oil from a transportation perspective, its importance in transportation, right? And the EV revolution has the potential to dent the gasoline and diesel part of it, right? But the reason why oil is the most important commodity in the world is that there's so many other industries that require petroleum, right? Petrochem, metals, for instance, like, copper or aluminum. Remember, like when oil spiked, it also spiked all the other commodities because their input costs require oil. Cement requires oil. Probably a lot of people don't know that, but it factors into so many basic factors of production. So I think oil is a critical thing to watch, and that's I in my in that pinned tweet I keep referring to, I talked about how this is obviously, I wrote that thread a couple of weeks ago before this latest OPEC decision, but I had predicted that OPEC would likely cut again before year end, because I think that the OPEC not only has an economic motive to support oil, but I think they have a geopolitical motive. Again, because one of the things, remember I talked about, like, at the beginning of 2021, how hostile the Biden administration was to the oil industry. He was also very, very, in my mind, unnecessarily hostile to Saudi Arabia and MBS in particular. Right? He chose on a number of occasions to deliberately snub him. Recall them. I think, like, in the first month of taking office, President Biden pulled the Nimitz away from the Middle East. I mean, these were all signs. These were all overt signals that he was saying, "Hey, we don't have your back anymore," to one of our longtime allies in the Middle East, who happens to be our biggest supplier of oil. And I think that was a big mistake. So, yeah.
So, Michael, you've spent a lot of time in the markets analyzing these different markets. And before we hit record here today, you kind of shared with me a little bit about how you see gold and the different roles and macro factors that push and pull it around. Why is it that you don't focus more on gold? Because I'll be remiss to not ask or focus a little bit for our listeners on your thinking around that.
Yeah. So look, the gold to me is a bit of a conundrum commodity. It's ironic because gold and precious metals were the very, very first commodity that I worked on back in the early 90s. When I started as an analyst at J. Aron at Goldman, I was basically a precious metals analyst for a couple of months before I wound up transitioning to a trading role for the GSCI and the other commodities. But the problem I have with gold as an investment thesis is that it's not really a falsifiable thesis. You don't know when you're really wrong. And I would basically say that sometimes gold is characterized as an inflation hedge. Sometimes it's characterized as a deflation hedge. Sometimes it's characterized as purely a fear hedge. So what is it? And I have a similar problem and argument against Bitcoin as well, right? It's the same exact argument. Mm-hmm. It's the chameleon trade. There's all the narrative keeps evolving, and so from and that makes it difficult for me to analyze. And we were talking earlier about the fiat money standard, and I think what is the gold bugs will always say that gold has been a store of value for millennia, and it can be that again. But I would say that something really, really changed starting in the 1950s. In the 1950s, again, this is something that we wrote about in our West Point paper presented in February. I basically said, look, this whole notion that Nixon just abdicated gold in 1971 and it was a total shock to the system, I think that kind of mischaracterizes reality. The reality is that in the mid 50s, when Britain instituted capital controls in its own fight against inflation, that spawned a very active search for an alternative. The pound sterling was the global reserve currency at the time, and it basically you saw the organic bottom up evolution of the eurodollar market in response to these capital controls. And so if you think about what eurodollars represent, they represent dollars that are unbacked by gold. And that happened organically. And so in a way, I think of the untethering of the dollar in 1971 as kind of an inevitability. In a way, I feel like he unshackled the US dollar from the inelastic confines of gold. And an interesting thing happened. Economic growth, nominal growth, exploded. If you look at a chart of like economic growth through the centuries, it's crazy. It actually looks like a flat line until around the Industrial Revolution in the mid 1800s, and then it started spiking. But then a really, really spike about a century later, just when the fiat money standard started getting adopted, right? So yes, fiat money debases over time. No argument there. It does debase over time. But my problem with the Austrian School of Economics and the hard money argument that we have to return to a hard money standard is that now that the fiat money engine of economic growth has been unleashed upon the world, and the world is used to essentially credit-driven economic growth, in order to put that genie back into the bottle, it actually requires austerity. And austerity is a pill that no government is willing to swallow. It would require major economic pain to go back to an economic standard. And so I see, unfortunately, it's the choice between debasement over time or an immediate debasement of assets and growth now, which is austerity. And so that's my problem with the whole argument that hard money will replace fiat money. I don't see it happening in my lifetime. So I think that's my struggle with gold. Mm-hmm. The success of the US dollar and fiat currency in general is the supply elasticity, not the inelasticity, right? So if you think about it, right, the reason why it's so hard to dislodge and why there's such a strong network effect of adoption is because there's an elastic supply. Mm-hmm. So the intellectual argument that I poke holes in and I have a problem with is this notion that, Bitcoin or gold is going to rule the world, it's going to have mass adoption, but it's inelastic. So you can't really have both. And there's some people that argue that, you could have a credit-driven gold standard. I'm like, not really. Not really. It's still inelastic. Otherwise, then you're back to a fiat standard. Mm-hmm. if you're talking about true elasticity, right? So that's it comes back down to supply elasticity, and for a money to be widely adopted, I argue now that the fiat genie is out of the bag, you require that supply elasticity. Otherwise, the only alternative is severe austerity.
To be able to continue growth and to continue usage throughout the economy that needs an elastic supply of this type of currency.
Correct.
Okay. So that's actually kind of, a little bit about where I wanted to go was this, the argument about de-dollarization. We hear a lot about it from both sides as, imminent and consequential, but how do you see the de-dollarization road here? And is it imminent in your view?
I also wrote about this a couple of months ago. I entitled it "Bricks a Brack" as a play on words, right? And we all know that bric-a-brac is just a bunch of sundry items that amount to nothing, and that's basically what I think of this whole notion of BRICS supplanting the U.S. dollar as a global reserve. I summarized it in a tweet a couple of weeks ago that I hope won't offend, but I basically said this: here's the state of BRICS, right? R and I no longer like each other. I and C have never liked each other. And R and C just find themselves in a tryst of convenience right now. But Putin really hates being Xi's bitch. And Xi remembers when Mao was Stalin's bitch. So that is an unstable marriage, if you can even call it that. Mm. And so all that's left is BS. And that's really I just see that as a stillborn concept, because I don't think any of those currencies can give the dollar a run for its money. In the world of fiat, it's you talk about network effects. Those are the dollar's network effects are pretty much unassailable. One thing that people don't talk enough about is that it's not just the adoption of the currency. First of all, what leads to the widespread adoption of the currency? It's obviously huge liquidity, right? But it's also the availability of a very, very deep supporting sovereign bond market, right? The U.S. Treasury market is the deepest sort of reserve asset in the world. So when people talk about, we're going to transition to a commodity-based basket or gold or what have you, no, I don't think so. I don't think so, because again, you have the problem of inelasticity. And can you imagine? Here's the thing, right? So imagine if a central bank, whether it's BOJ or PBOC, needs to fund whatever it is they need to fund, whether it's a budget deficit or capital projects or what have you. Can you imagine if all of their reserve assets were in gold and they needed to sell a big chunk of gold? What would that do? Right? The sword of inelastic supply cuts both ways. And when you have that kind of inelasticity and illiquidity, it could never serve as a viable global reserve asset, in my view, in today's world. Again, in today's world, it used to, but now that fiat growth demon has been, or genie, I'll say, has been unleashed, it's pretty hard to put back into the bottle unless we're willing to go back to an industrial revolution era of growth, which I don't think I don't see any country willing to go down that path. Maybe it gets forced upon us, right? I mean, that's the end game, right? We don't know. But so far, the country that's closest to that end game, the obvious country, is Japan, given the high amount of debt to GDP and the huge amount of JGB holdings that the BOJ actually owns. But I would argue that far surpassing Japan is China. It's just that you can't see it, right? We talked earlier about
privately held and the way they have it,
right? Because it's dispersed in all these off-balance sheet vehicles. But like if you like, there's been a bunch of news articles lately about how there's there's bad debts at the local level that account for 12% of Chinese GDP. 12%. It's a stat. When I read that, I was like, holy shit, that is a staggering number. Who's going to absorb all that? Mm-hmm. Well, eventually it has to get nationalized, right? Eventually they can keep kicking the can only so far, but eventually there's only one last can or one last holder of that can or one last bag holder, whatever you want to call it. That's got to be the PBOC. Mm-hmm. So like the PBOC's apparent debt to GDP ratio is a complete facade.
So does that, I mean, is there any way to kind of analyze which of those dominoes kind of falls first?
So that's always the thing, right? So Mike Green and I have talked about this Minsky moment for China, and it's been so. Look, we all agree. Everybody that's been betting against the Hong Kong dollar, that's like a widowmaker, like shorting the JGB, right? Mm-hmm. It's been a widowmaker for decades. But we can both agree that whenever that Minsky moment happens, we can both agree that we're a lot closer to it today than a decade ago, just given the sheer enormity of debt that's been incurred there, and the slowing growth. So the cracks are starting to appear, but I don't know. Who knows? For all I know, they could continue this charade for another decade. I would take the under on that because I think China's got a lot of other issues to contend with. There's a huge demographic problem, as we all know, right? So all of these things are coming together, coming to a head, and I don't know what the domino effect is, but I'm actively betting against their ability to hold their shit together. I mean, full disclosure, I'm short Hong Kong dollar and Chinese yuan offshore. So,
well, Michael, I want to be respectful of your time. I'm sure there's a million threads here that we could keep pulling on, and maybe we can have you on again to have a part 2 of this discussion. But for anybody that's interested, all of your excellent writing, lots of graphs, lots of interesting ideas that are all pulled together in one place are all available at Urban Cowboy, Kao, your last name, urbancowboy.com. And of course, your Twitter feed at Urban Cowboy, spelt the same way, Kaoboy, right?
Yes. Thank you so much for having me. What a pleasure, Tom.
Thank you, Michael. I really appreciate your time, and I look forward to our next chat.
Likewise.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.